Hey everybody, what's up? We are back, and seeing as my last video was about half an hour long, this one is going to be short and sweet. We are going over the fundamentals and just overall feelings I have to my long-term holds. So going to show them in the portfolio in just a moment, but basically these are the stocks that I have a long horizon on, or I already had a swing trade completed on them, and now I am holding a couple more shares just to continue to maximize the profit that I can get on them. So make sure to subscribe and let's get into it. So, quick portfolio update. If you didn't see my last video, we are at 41,451.8 almost percent for the year. So, looking very, very strong, almost heading into Q3 with just under $4,000 realized for the quarter, which is pretty cool. As well as that, I have another 600 unrealized. So we are looking very, very good for this quarter and just for the year as a whole, which is great. So anyway, the stocks I'm going to be focusing on, these I reviewed all in my last video. These are my shorter term swing trades. Today we are going to be focusing on the long terms here and going into some fundamentals. So starting out with CNC right here, CNC dropped massively a couple months ago due to just massive weakness in the health insurance sector, as well as just the company as a whole had massive cuts to their earnings estimates and things like that. But again, mostly attributed to weakness in the sector. Um, because of that, they had an insane valuation. Their PE, I believe, was right around like 6 at one point. So my cost average at the moment is at 26.38. The current price is 33. So we are looking very, very good. If we go into, I actually don't have the selling and buying history like I do with all of these other stocks up here for CNC, only because CNC is the reason I started recording every single purchase in here that I would do, which you can see for these other ones. And so I just have my actual exact cost basis in for them instead. But now with every other company, I do that. But anyway, let's get into it. So biggest thing is there was weakness in the sector and the stock, and now there isn't as much. So seeing very strong growth in sales. If we go to the quarterly view, we can see it is continuing into 2025. The only difference is their net income, which you could see going negative in the last quarter. That, I believe, will change and hopefully improve going to 2026. You could see the profitability chart down here, but basically, I'm expecting it to improve. And the valuation just overall at the moment is very, very strong. Let's see if we can get the, yeah. So right here, PE ratio of the last quarter was 13 during the last report. Now it is actively, I believe, I want to say current is showing as 8.4. It might be a little bit lower than that. I don't know when the last time it was updated for this, but very, very low and expecting that to continue. So you could see that they're expecting pain for 2025 with a very significant recovery for 2026, which I think will be fantastic for the company. Yeah, so that's all I want to go into with them. So next up, let's go into Novo and get into those. So Novo Nordisk has been going through a little bit of a rough patch in their relationship with themselves, but overall, incredibly strong growth in sales trends. Even in their last quarter, it was very strong. I believe Q1 and Q2 are seasonally lower for them, which you could see here. Year over year, total revenue 9.5 compared to 11 this year. So overall, very strong, and yet their chart has been getting annihilated. Which, let's see if I could bring up their chart. Yeah, okay. Sorry, I'm still getting used to the controls for TradingView on the desktop, but basically they are very, very low at the moment compared to their recent highs, dropping, let's see, over 60%, which is rough, to say the least. So anyway, I'm expecting that to improve just given the strength that they're seeing. Um, their PE is nowhere near as low as CNC's are, but still 15 for one of the highest revenue pharma companies in the world. I think they're going to be doing fairly well. You could see their valuation in prior years is way lower now than it used to be. They've been over 30 since 2021, and now they are sitting at 15 right down here. So overall, I think it's going to be pretty solid. And yeah, my note here, easy long-term recovery. So next up, Paramount Skydance. Now this was kind of a situational buy where they dropped a ton off of, if we go in here, if we go in here, they dropped a ton after their merger that they just went through. I don't know what this channel is, but let's just ignore that. And basically went through the merger, pain. Merger finalized right here. They dropped massively. I bought a little bit on the bottom here, and actually we can see exactly what I did. So I bought at 1036, literally 10 shares. I put $100 in, doubled it at 13, and then I tripled that at 1338. So I don't have a ton of money in it. Balance is 1100, which is pretty solid, but I am up 45% at the moment, and that is because they announced the UFC deal. Now, I'm not going to get into their financials and charts and everything because honestly, the results aren't great. The point is the potential here. So, new leadership, the merger completed successfully. They just announced a giant deal with exclusive UFC streaming, which is going to be massive for more subscribers. And overall, they also just announced a possible acquisition of Warner Brothers, which again, huge increase to the business. Expecting a bunch of big things for them. Basically, they're making huge moves after the merger, so should be interesting. TMC is another one where I'm not going to go into the specific charts and financials here because they're not good. The point is the company. So TMC is an exploratory deep sea mining company specifically for rare earth metals. 80% plus of rare earth metals are controlled by China, and I believe 90% or more of the refining of them is controlled by China. There is one company currently, the ticker starts with an M. I don't remember what it is, but it's based in the US and they are also very small. But TMC has so much potential because if they can get the licenses they need and get operations started, especially earlier than scheduled. So I believe commercially they're going to try to start up some things in 2027. And then hopefully, I don't remember. Their timeline is very long though, but I feel like it is too good to not just have a couple shares of. So I've been buying a little bit as it's been dropping. My last buy was at 460, so I'm up a little bit, 7% at the moment. But this is the kind of stock that I'm just going to be slowly accumulating over the next couple years, ideally. Now we'll see if that actually happens, but yeah, that's about it. Huge, massive potential. Rare earths are realistically only going to get more expensive and more demanded. So if they can capitalize on that market and hopefully operate successfully, it's going to be massive. Now, KDP is another one where I'm not really going to get into the actual specific financials. While they are solid, it is a big, mature company, so they look perfectly fine, basically, is what I'm going to say. There is a lot of debt, which I am not worried about. And the reason why is because they just announced a massive acquisition, which is part of the debt problem. But more importantly, the company is splitting up. Now, they got married a couple years ago, Keurig and Dr. Pepper, and now they're splitting again. So Keurig has most of the debt from the large acquisition, which was in coffee. So they may struggle, but the Dr. Pepper side of it, I believe, will do very well for itself. I believe they'll also be keeping the energy drinks sector where they just had a big acquisition recently as well. So basically, I think there's upside for both and growth potential for both. But getting shares of both companies in the future is going to be awesome, in my opinion. And Yeah, that's about it. Should be a pretty solid long-term play. I think both halves of the company have a lot of upside, basically. And finally, PayPal. PayPal has been probably the most consistent company in my portfolio for the past 2 years or so. And the reason for that is that they have not gone up at all in 2 years. They're at basically the same place as they were in whatever, maybe a little bit higher than September 2023. But basically, the company has not seen good momentum in a while. I'm hoping we get that soon. If we go into their financials, I mean, they're looking pretty okay. Growth is there. The line goes up. Usually, when lines go up, that's a good thing. The year over year growth of their revenue is strong. Operating income is strong. Let's see. Net income over the last 2 quarters has been fantastic. So, overall, there should be some upside here. I do think compared to peers, they are undervalued. If we go into the stats here, we can see for sure. Price to earnings is at 14. So for a relatively high growth and dare I say one of the more mature fintech companies, having a PE of 14 is kind of wild. So yeah, that's what I'm going to say. That seems absurdly low, to say the least. So you can see historically their PE has been in the 40s, 50s, even 60s. And over the past few years, it has been dropping a lot. And most of that is because of the downturn in their stock that we saw here. So, should they be able to recover and catch up with where their peers are just in terms of the PE ratio, which would require the stock to go up, that would be massive. But either way, I think there's a lot of upside here. So, that's all that matters. Financials are strong, price is low, and that is kind of the perfect recipe for a relatively decent stock to buy. Also, if you look here, which I am using the log chart, by the way, which is arguably a better version of charting to show patterns, but they recently bounced off of this long term support that they've been having. So hopefully we can see it rise higher from here. But either way, I think the value is there. So this is, again, long term plays. But other than that, I think that's all I wanted to go over today. Long terms, it is 24 just about percent of my portfolio. And the point of this is alongside bonds, ETFs, I want to have a more anchored portfolio that isn't as susceptible to if one of my swing trades goes wrong and it tanks my portfolio. I'd like to be protected a little bit more against that. So alongside having ETFs, which are kind of an anchor to the portfolio, I want to have some just long-term stocks that kind of add to that stability a little bit more. Uh, Bonds are going to be going away soon because Vanguard doesn't support bond purchases under $10,000 anymore. And I believe it happened on September 12th. So that is unfortunately not going to be a section of the portfolio anymore, which sucks, but now I'll just have more cash. What I'm probably going to do is put about maybe half of this bond money into my ETFs, just to keep the kind of stability side to having the bonds. But other than that, I'll just have more cash and probably more money to do swing trades with, which is fine. But yeah, that's about it for today. So thanks for watching. Hopefully this video wasn't as long as the other one. I've been talking for a while, so I'm not sure. But thanks for watching. Subscribe, and that's about it. See ya.